Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about Coinbase. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at a long call spread in Coinbase. We talked a little bit about our weekly email that we put out about the markets, and that topic that Lindsay Bell discussed, our Chief Markets Strategist, was about the fact that a lot of the cryptos got a lot of action over the Super Bowl. There were quite a few cryptocurrency commercials overall. So we were just trying to do a momentum trade on Coinbase. The stock is very volatile, and because of that, we were looking at a long call spread. So I'm going to start by showing the long call spread. And this is inside the options playbook. So with a long call spread, we're trying to manage our risk as opposed to just buying an option outright. If I'm buying that option outright, then I am the amount that I pay for it is my maximum risk. Here, as opposed to just buying an option contract, which would be strike A in this situation, we're going to sell an option contract too. So it's going to lower the actual cost of the trade overall. And on volatile stocks, you're going to receive quite a bit for the out of the money option contract just because of pure volatility. So when I do a long call spread, I am doing it for a net debit to the account. Whatever I pay for that long call spread is going to be my maximum risk. So what we tried to set up is a trade where we had more upside than downside overall, and then we could just let the trade ride. That is the way that we would approach it. So let's look at and see what happened with Coinbase. So I'm showing the chart here. This is Tuesday. It's a 15-minute chart overall. So Tuesday at noon, we see this is where the underlying stock was at. It was right around 96, according to my screenshot that I took. So it was right around 96. And during the call, we had a huge move down, came back up. So this is from the beginning of the call to the bottom of the call. This is, where is this? 12:30 is right here. The market did actually move quite a bit to the downside overall. So you might have got a better fill than what we were proposing as far as the paper trade is concerned. And as we went throughout the day, market stayed flat. Up, I guess up a little bit at the end of the day. Then we had a fairly decent up move the very next day. And we did talk about this in that when you're doing a long call spread, you'd rather have your forecast be correct a little bit closer to the expiration date, because that option that you sold needs to wither away and have some time decay. And two things that can happen to reduce that premium is we approach expiration and we get time decay in the option contract, or implied volatilities actually come down, and that can help that situation too. By the fact that this happened the very next day, the big move to the upside, I don't know if there would have been much opportunity to get out at too much of a gain. And then you see that now we did have a big down move, and now we're all the way down to about 185. So we started at 206, we're at 185. Makes for a great learning, because now I'm going to look at, we had a question on the show from Wayne, a longtime listener, and Wayne was asking why can we look at, one second here, I'm going to have to clear my throat. I'm still battling with this little cough here. One second. And I'm back. And he actually foreshadowed, that we might need to adjust this and how we would do it. And the answer is we would roll it into a butterfly. I don't know if I would do it at this instance. we build the trade as we're going to put this on, we're going to have limited and known downside risk, and we're going to have more upside than downside. So if you wanted to adjust the trade, that's what the stock play of the day overtime is all about. I will show you an adjustment that I would consider. I don't know if I would consider it right now. I want to be a little bit closer to the expiration date. But if you're nervous the stock's going to continue on down, then I would definitely consider it. So it's all about your forecast for coin going forward. Okay, so, and by the way, we talked about the cryptocurrencies. Coinbase, I should just give you a little bit of background on it. You can go back and learn a little bit more about it if you listen to the on-demand video. But overall, Coinbase is an exchange that trades cryptocurrencies. It's one of the, I would say it has the best reputation as far as being a legit exchange, trying to work with a lot of people as far as the compliance of the product is and all the regulations. They have a sound management team overall. Okay, so here's where Coinbase is at today. It's down 3.4%, so that's nothing to sneeze at. We went out to the March 14th expiration, which I'm highlighting here on my screen. And as I scroll down, we see that in 2000, the 207.50 strike call was the call option that we bought. The stock was right around 206. So that was just out of the money. It was a very expensive option contract, and it still is a very expensive option contract. We then sold the 212.50 strike. So we went 5 points wide. We paid about 2.25 for it. And actually that price went down during the call because we always do this live. And you're looking at, like in this instance, we got 100% implied volatility. Obviously, the markets have changed overall. There's a lot of stuff that's going on with Russia and in the world. There's just a lot of news that has happened over this week, let alone the fact that, we're just talking about a cryptocurrency. So we have higher implied volatilities than we ever had. There was an opportunity. You would have been up on that trade for sure. I just don't know exactly how much you would have been up when the stock went through the 212 and went up to about, we'll call it the 215 strike. I think it got to 214 or so. So you should have been profitable on that trade. I don't know if you would have closed it out just because it happened so quickly overall. Now, here's the adjustment. When we talked about this on the show on Tuesday, we build this as we're going to put the trade on. We're going to pay $225 for it. We have a 5-point wide spread. We're looking to make $275. You could just let that trade ride and see if there's ever that opportunity to make that $275. As a matter of fact, I would always have a limit order in to try to sell it at about $450, right? The maximum it could sell for is $5, but I would keep that limit order in there just in case the stock gets up high enough that you could close it out at near the maximum of the trade. That order would always be in once I put in a long call spread. Now the market's gone against us. How do we roll this into a butterfly? How do we take a little bit more risk off the table overall? Okay, if we closed it out right now, I have the trade all set up. Here's the buy, here's the sell. We could close it out and bring in $1.25 net credit to the account. So that means we'd lose $1 on our trade or $100 for every 1-by-1 spread that we did. Now, what I propose is something where we're not going to bring in that $1.25, right? We're not going to get as much of a credit, but we're going to bring in a credit and we're not going to add any additional risk. How would we do that? Well, you'd leg this into a butterfly and you'd still have a position on, you'd still have the potential that if it bounces back that you can sell it and actually make a gain on the butterfly overall. So I like to call this trade, I don't want the cheese anymore, just let me out of the trap. And I'm just going to let this trade ride. So I come in, I'm buying, excuse me, once again. I'm buying the 207.50 call, selling the 212 call. I need to sell one more of the 212 call. That's going to bring in the credit. Then I'm going to buy some protection. I'm basically selling a short call spread to combine with my long call spread to form the butterfly. So I'm legging into it. I put that trade on. That means that we would have sold one more of these. and we would have bought one additional 5 points out 2017.50 call. Okay. Now, if we did all that trade, if we go back and make this the actual adjustment, we would get rid of this trade, right? And this quantity would be 1, and you would be bringing in a net credit of $1.10 to your account. Remember, if we just sold the spread, we were closing it for $1.25. So now we're going to have a butterfly on, which could still make money by that expiration if the stock comes up close to the 212 level. But we're bringing in, I think $1 is a solid amount, but we're bringing in a net credit of $1 to the account, meaning that we've reduced our risk on our long spread by $1, right? So our total risk now would be that 125. That would be our maximum risk, but we are now then long a butterfly. All right. So let me clear this out, and I'm going to show it in the profit and loss calculator. This is one of my favorite adjustments to do on a long call spread if the market has gone against me. Now, once again, you can wait. There's no reason to do this trade right now. Based off of our forecast and our outlook on Tuesday, you could just let the trade ride, but this would be an adjustment. And I'll talk about the downside of the trade once we look at it in the profit and loss calculator. Okay, so let's clear this out. And I'm going to set up just a butterfly just so that we have it all clean. Okay, so that would be 207.50, selling the 212, buying the 217.50, 1 by 2 by 1. All right. Now, if we look at the Ally Invest profit and loss calculator, this is what the butterfly would look like. If we just initially put it on, stock is all the way down here. Our sweet spot is right here. Still have a lot of vol premium in it. So if it bounces back once again in the short term, comes all the way back to 212, we're not going to be able to sell the butterfly for a ton. But if we get closer to the expiration date, I'm going to go all the way down to 0. And I think I'm going to have to even change the vol a little bit. If we lower the vol a little bit, which would probably happen, I'm going to go even a little bit more. Gosh, saying 102 volatility. All right. Then as that happens and expiration approaches and these premium comes out of the option contracts, well, then you see that, okay, well, I can still make up to $5 on the trade. Downside is I've sold another option contract, so I have to get closer to expiration for the butterfly to start paying, because I now have 2 option contracts versus 1 that I'm short. And in order to make the maximum, we need to lose some time premium on those. And then as I continue on up, I do have risk. So I need to now land within a 10-point landing area. But I brought in $1, I reduced our risk by that $1, and I still got a position on. I still have something that can benefit from the bounce back. Now, if you look at the trade, here's the way it went. So I'm going to try to kind of graphically show what we did. If I uncheck this box, it gets rid of the option contract we were buying. I adjust this back to the 1, and you see here, now that we graph it, that was our initial position. Market went against us. Here's where the market's at right now. Market was up around here. This is our initial position. Now let's go back and make the adjustment. We sell 1 more of these. We buy an additional option contract there, bring in a net credit of about $1, and now it looks like that. So our offsetting trade, so hang with me here. You saw the long call spread, and you can zoom back on the on-demand video if you'd like. And this is the offsetting trade. Sell 1, buy 1. And we graph that. And that is the short spread that we're adding to our long spread. Make sense? Hope you hung with me there. A little bit of an advanced topic. Don't let it scare you, though. If you planned on putting this trade on for 225 and you were saying that's my maximum of my trade, that's the most I'm going to lose. One of the biggest things is you just don't want to over leverage in that scenario. You don't want to do too many of them that you aren't comfortable with the market going down. But this is a very interesting alternative, and mainly because what has happened is and this is the marketplace as a whole. Let me scroll up. I'm sorry, I'm looking for the chain, but it's right up here. Is that implied volatilities went from, if I recall, they were around 80% implied volatilities, and they spiked now to up over 100%. The at the money volatility is at 101. So that makes it, the fact that there's more premium makes it more feasible to do this adjustment and receive a decent credit for legging into the butterfly. So I guess one of the things that is true is that if I'm going to leg into the butterfly, the fact that we still have 14 days remaining to expiration does help, because you're bringing in more premium, right? The longer the option contracts, the more of a net credit to the account you can bring in. All right, that's the adjustment. So a little bit of a long-winded explanation, but we don't always get an opportunity where the stock has actually made a big move when we do the show on Tuesday to Friday, where you can kind of talk about an advanced adjustment like this. So it makes stock play of the day a lot more interesting if the market does go against our paper trade, as opposed to if we're just always right on our forecast. And as always, last disclaimer, this is not meant to be a recommendation. You need to take these concepts and apply them to your underlying stocks that you want to trade. That's it for this episode of the Stock Play of the Day. Please click subscribe, ring the bell, and you'll get the alert for this Tuesday's Stock Play of the Day. And we'd love to see you there. Thanks for coming, everyone.